Recently, we saw the memory chip market came crashing down. We have SanDisk down more than 30%. We have SK Hynix also down more than 30% over the past month. Then we see Micron also down more than 10%. Now, with the stock market, with the Korean stock market trading at all-time high and also came crashing down, a lot of the retail traders and investors over there have been unwinding their leverage and margins because of the change in the market cycle. So as value investors, when we see some of these memory chip players come crashing down, is it a good time to buy now? And if you're holding on to some of these stocks, should we sell? Let's find out in this video. Now, this video will be an interesting one because I want to share with you one of the books which I used many years ago and even today to figure out how to actually buy some of these semiconductor stocks, how to actually value them, and what is the right time to buy them. So this book is called, let me just quickly share this with you. This book is called Capital Returns. And it was actually written by this author called Edward Chancellor, an economist, and he figured out how to actually look into semiconductors. So I want to actually focus on the valuations, on how to buy them towards the end, and I'll share with you the specific chapter later on. So do stay towards the end. Now, let's take a look at what memory chips is and why is it causing a huge surge in the stock market earlier on this year. Now, memory chips help to store data, right? They help to perform multitasking and feed it to a computer. So it's a lot like when you use your laptop or your smartphones. All these memory chips are required so that you can actually listen to your music, surf the internet, play games all at the same time. It allows electronic devices to multitask, right? So these chips are actually used in smartphones, game consoles when you're playing a lot of games, cars where you have electric vehicles these days powered by technology, home electronics, you're looking at refrigerators, you're looking at some of the kitchen appliances which use smart technologies, and now data centers. So this has actually caused memory chips to become very popular. Now, there are two types of memory chips you need to know. Now, the first one is what I call NAND, or not and, pronounced as not and chips. Now, these are your flash storage, which helps to store and retain data, and they're commonly found in your USB drives. The second type of memory chip is the more commonly DRAM memory chips, or dynamic random access memory. So these are the memory chips which are commonly found in your CPU, in your computers. And what they do is they help to multitask your computer. So when you're using your laptop, when you open up multiple windows, you're listening to music, you are running some of your video editing software, you need to have a high amount of DRAM, right? High amount of memory to allow the computer to be able to multitask. And the thing is that the rise of AI today has led to stacking multiple of these DRAM chips and even some of these not AND chips that is known as high bandwidth memory, or HBM. So these are what you call HBM chips. They basically stack up on top, like a parking lot. So different layers. This allows them to squeeze as many memory chips into one layer, into one specific unit area of a semiconductor chip. And these are widely used in data centers today, right? When data centers, with the massive growth of AI platforms, AI companies using a lot of platforms, softwares, AI-related softwares, there needs to be a huge growth of data centers, and data centers require all these chips. So they need more, these AI companies, these AI platforms, they need more DRAM, they need more not AND chips to handle the AI training and the cloud computing workload. And as a result, you have hyperscalers, Google, Meta platforms, Amazon, Microsoft, where they're building huge amount of data centers for their cloud storage space, for their AI training. They're willing to pay a huge amount of money, a huge premium for some of these memory chips. And as a result, memory chip makers are then trying to divert their resources, their capital resources towards making some of these higher margin HBM chips for AI rather than smartphones, your PCs, your gaming consoles, and other consumer electronics, right? So you can see a lot of these memory chip makers like SK Hynix, SanDisk, Micron, even Samsung, they're producing a lot of chips But these chips are diverting towards building some of these, selling to some of these AI related companies. In fact, Micron's CEO said that there's a huge supply gap, right? They are only able to supply for some of their key customers in the near term, and only able to satisfy about 50% to two-thirds of their requirements. This means that a lot of these companies, right, gaming companies, smartphone companies, computer companies, which requires all these memory chips, they're not getting some of these memory chips. And instead, these memory chip makers, they're selling all their products to some of these AI platforms, these AI companies. So the question is, can we just ramp up or just increase the capacity in some of these factories, right? The problem is these factories cannot just churn out more HBM chips just because these chips are so hard to produce. What do I mean by this? Now, this simple image by Bloomberg shows you how small some of these HBM chips are, right? You can see that the HBM chip, you can see on the far right here, the TSV column, this is actually only 5 micron wide. So it's actually multiple times less than a human hair, which means that a single defect, right? Like let's say if there's dust going in, there's dirt, there's some form of impurities inside these chips can actually destroy or compromise an entire stack of HBM chips. So this makes the production much slower. It also yields the chips much lower as well. So because of this, the recent quarter has also led to some of these memory chip makers making huge amount of profits. Right? You can see Micron, SK Hynix, and SanDisk are making strong profits here. Right? Let's take a look. So you can see here earlier on, SanDisk has released their latest fourth quarter 2026 results. They can see that their fourth quarter revenues were up 51%. If you see their numbers here, based on a quarter to quarter basis, SanDisk net income grew by 91%. Based on a year on year, it grew from net losses to net profit. So they have been growing because of this huge demand by some of these AI companies, by these AI scalers for their memory chips. Now let's take a look at the other companies. Let's take a look at Micron. You can see Micron in its latest fiscal quarter results, revenue has actually grown by a huge amount compared to the last year. Net profits has grew from 1.8 billion to about 28 billion dollars. You can see this is a huge jump in the latest quarterly results. Now, how about SK Hynix, which is one of the largest Korean chip makers? SK Hynix also reported record revenues, record operating profits, and also a very strong net profit margin. So this has also resulted in SK Hynix performing very well. And when we see such strong profits, sometimes you might think that, hey, is this a signal to start buying some of these stocks because the share price have been down, but the profits are doing well? So is this a big signal? Let's dig deeper into it. So the thing about looking at memory chips, right, is that we have to understand what this memory chip business is all about. And if you look at memory chips, they tend to be in a very cyclical industry. That means there will be some years where they're making huge amount of revenues and profit. That's their boom years. There's some years where they are in their, when they're not doing well because there's a huge oversupply. So it goes in a boom bust cyclical industry. And the reason why is because they are a very commoditized product. They don't have a strong competitive advantage. Their prices, their prices and their margins tend to be very razor thin. So this tend to attract a lot of competitors. In 2023, Micron and SK Hynix actually lost billions of dollars in an industry-wide oversupply. So it's only just a few years ago that you see the memory chip industry has actually faced a huge oversupply issues. What this tells me is that memory chip profits are not exactly predictable. All right, so you can see if we take a look at some of the numbers in some of these memory chip companies. So let's take a look at Micron. You can see Micron here over the last 10 the last 10 years, last 10 to 13 years or so, the past decade, you can see the free cash flow has been really volatile. There'll be some years where they've made very strong free cash flow, positive free cash flow, some years where they have negative free cash flow, like in 2023. Now, what is free cash flow? Free cash flow is basically taking the amount of cash profits, the operating cash flow of a company, minus the amount of capital expenditure or the capital spending. That's the free cash flow. So it's the amount of cash profit which goes into the company's bank, into the company's pocket, minus off the amount of capital spending they need to reinvest into the business to grow the business. So what you want is to find companies which have a very stable, predictable free cash flow. You don't want a company where some years they have very high, very strong free cash flow, some years where they have negative free cash flow. Negative free cash flow means that they are actually putting out more money. They are actually spending more money to expand the business than they're actually collecting profits or collecting their cash profits. So you can see here that Micron moves in a very cyclical manner. You can see the free cash flow. Some years is going up, some years is actually coming down. All right. So now let's take a look at the other chip makers. Let's take a look at SanDisk. SanDisk, you can see over the last 10 years, the free cash flow has been dropping between 2013 all the way to 2022. And then you can see here, 2023, they had negative free cash flow, 2024 negative free cash flow, and only in last year, right, in their latest financial results, they have a huge jump in their positive free cash flow. And that's because of the recent shortage in supply of memory chips. Let's take a look at SK Hynix. SK Hynix, it seems like it's also the same thing as well. You can see that the free cash flow, some years, is positive free cash flow, some years are negative free cash flow. And only in the recent quarter, there's a big jump in the free cash flow. So what this tells me is that all these memory chips, their free cash flow is very unpredictable. There are some years where they are making really good money. They're collecting a lot of cash profits. There are some years where they're just putting a lot of money inside in order to compete in the industry. So it's a very, very competitive, intense competition industry, which means that there's no way of predicting profits. So when it comes to valuing this kind of businesses, now when it comes to valuing a business, what you want to do is you want to look at businesses where they are able to actually bring you very decent, predictable cash profits or free cash flow. All right. So the question to ask us right now is, are memory chip stocks, is it a buy? Is it a sell? Now, how do I actually value it? Now, should we use the intrinsic value, which uses the discounted cash flow method, or the P ratio valuation? So let's find out here today. So if we look at my intrinsic value calculator, so this is a calculator which I create for myself, for my members. This allows me to be able to value a company. Now, the problem with memory chip makers is that when you figure out that they have very unpredictable free cash flow, it makes intrinsic valuation very difficult. Why? Because intrinsic value, right, you actually have to project your future free cash flow. You need to figure out roughly how much a company is able to produce its free cash flow over the next, let's say, 10, 15, or even 20 years. So you want to, when you're looking at this kind of companies, when you want to value this kind of companies, you want to make sure that the free cash flow is either consistent or at least growing. Now, since Micron has a very volatile free cash flow, it is very difficult to figure out what is its intrinsic value. Why? Because you don't know what's the next year's free cash flow is going to be. How is their free cash flow going to be like 5 years from now? Because there's some years where they produce positive free cash flow, some years they produce negative free cash flow. So because of this, it's very, very difficult to use the intrinsic valuation. You can see here, intrinsic valuation, you are required to project the free cash flow. So you want to have at least a consistent growing free cash flow. In this case, it's very, very tricky. Now, when it comes to, then can we use the PE ratio to actually calculate, to actually value this company, knowing when to actually buy? It's also a bit tricky because what is P ratio? P ratio is basically taking the price of the share divided by the earnings. Now, when the earnings goes up, when the earnings growth goes up a lot, what happens to the P ratio? The P ratio drops, right? It becomes a single digit. So it seems like today the P ratio for these memory chip makers are cheap because the P ratio is in a low single digit. But that's also because earlier on I shared with you, Micron, SanDisk, SK Hynix, their earnings have shot up. They have generated a lot of profits in the recent financial results, and that has caused the earnings to jump, the E to jump much higher than the price growth. That's why the PE ratio is actually very low. So in this case, it does seem like it's a value trap for investors looking into investing in some of these memory chips. So if the intrinsic valuation or the DCF model is not feasible and we can't use the P ratio valuation, then how do we assess when to actually buy some of these memory chips? What's the right price level to actually pay for these memory chips? Now, I like to use this book, which I've read many years ago. I'm also using this book right now. It's called Capital Returns. It's written by an economist, and I really like it because there's one chapter which I read, and this spells out entirely the whole semiconductor industry and how to actually price or how to actually buy or sell these stocks. So in any capital cycle, companies where they follow a cyclical, a cycle like semiconductors, for example, you want to actually refer to this. So in any industry capital cycle which uses a lot of capital, where their profits tend to be cyclical, you can refer to this very simple chart. So industry capital cycle, what happens is that usually the start of the capital cycle is when investors are pessimistic, right? They feel that the whole industry is going down, it's not going to improve. No one is going to invest in these businesses. There's a lot of industry consolidation, and many of the companies start exiting. So this is when you want to start buying. Why? Because when you start buying here, this is where you can take advantage. You can be early on in the game. Now, as capital spending starts to exit, they realize that there's not enough supply. Then the capital starts to come back again, right? So this is what I call improving supply side causes returns to rise above the cost of capital. Companies or the industry insiders start to know that there's not enough capital, and that starts to attract outside capital again into the industry, and this causes the supply to go up because there's still that consistent demand, say for example for semiconductor chips, and because of this the share price started to grow. Now what happened is that as more capital starts to come in, it's going to invite new entrants which are attracted by the prospect of high returns, and that's what we are really seeing earlier this year, right? Investors are very optimistic about memory chips. That attracted new entrants into the market because of the potential high returns selling to some of these hyperscalers, to some of these AI platforms. What do you think happens when some of these new entrants start to come in? Rising competition. There's a lot more competition, and that actually causes the price cutting to actually take place, and that's where the share will start to underperform. And this is actually what is happening right now, because the biggest enemy which this whole industry is facing right now is none other than China. Right? You can see that CXMT, one of the biggest memory chip player in China, has recently got listed, and they're actually fighting against global memory giants. And we know that when China comes in, they're definitely able to push down prices for these memory chips. So you can see here, this simple cycle, from this simple cycle, you are able to figure out when is the right time to start investing, right? We can start to see today with a shortage of supply, there's a huge amount of optimism, there's a huge amount of demand. A lot of players are also starting to come in. Now we can start to guess where are we in the cycle here, right? So we are definitely not at a point where investors are pessimistic. We are at a point where investors are really optimistic, and that means that the next step is that we are going to see much more competition coming into the industry. So when we are looking into some of these businesses, when you're looking into some of these sectors, sometimes it's important to take note of what type of sectors we are actually investing in. If you're investing in a semiconductor industry where the product itself is very cyclical, it's a very commoditized product, and you can see the profits. Obviously, there are some years where they're doing very well, some years they're not doing very well. It's very difficult to predict these profits. It's difficult to use the intrinsic valuation or the discounted cash flow method. And because of this cyclical nature, it's also very difficult to use the PE ratio, because then you see the strong earnings would actually pull down the price to earnings ratio. That actually would mislead investors to thinking that this could be an undervaluation, where in fact this could be a value trap. So with that, I hope you have enjoyed this video on memory chips, on whether to buy or sell now. I hope this has been a useful video for you. If you like this video, do like, follow, and share this video, and I'll see you soon.